Hi, good morning to everyone who's joining. I'm just going to give it about 30 seconds before I start off to make sure everyone's connection is sound. Okay. Good morning to all. Thank you for taking the time this morning to attend Marcia's presentation on warranty indemnity and tax liability insurance. I'm Chris McDermott. I head up the private equity and mergers and acquisitions practice for Marsh in the Pacific region. And I'm joined today by Kane Sim, our head of tax for Pacific, who will shortly be also assuming management of our broader transactional risk practice. So I'm delighted to be speaking to all of you today because I think that we're going through a very, very interesting time. We're seeing certainly an effect recently on M&A transactions. And we think that some of the insights that we've gained from our vantage point over the M&A market generally, should be able to be interesting to you all and help you as you go through transactions. Now, in terms of the agenda today, I'm going to touch very, very briefly on who we are and what we do in the PIMA practice. Talk about the state of the market, kind of what we're seeing from a 10,000 foot view. Going to go into some of the nitty gritty of warranty indemnity insurance and how it can be used in an innovative and somewhat novel way in the current market. And then Kane is going to touch upon tax liability insurance. Now, at the end, we're going to leave time, of course, for questions. And we're also going to go through some interesting recent case studies. I do want to address you all, our audience. I understand we're joined today by a number of corporates, private equity firms, and advisors, all of whom serve as referees for our work into transactions. And we think that the content should be relevant for all of you. Okay, so briefly, what is the private equity and M&A practice? Well, we're a part of the larger Marsh business, of course, and we're a team that works for clients as they go through transactions, and we also assist, of course, in the post-transaction insurance integration process. The key takeaway from this slide really is that PIMA itself has offices on every continent and in every large financial center around the world. What that means is, number one, that we're staffed up and have all the capability we need to do cross-border transactions, which are typical. But more relevant, I think, for local deals here in Australia and New Zealand is that we're able to draw upon the collective experience of our colleagues from around the world across thousands and thousands of transactions. So this slide represents really what the PIMA practice does in a nutshell. I mentioned before that we are a practice that assists clients with transactional work, but we don't think about ourselves as only a transactional practice. In fact, we think about the entire investment life cycle and how we can add value to private equity firms and to corporates as they consider transactions, both buying and selling. So in the early days of, say, a private equity fund being formed, we have teams that would assist with some of the house account insurances, things like general partnership liability, to ensure that the general partners themselves are properly insured. And then as that fund or that corporate starts to go through transactions, we assist with the sort of pre-transactional diligences, focusing, of course, on insurance. And then we help out with a number of transactional risk solutions, things like warranties, indemnities, insurance that we're going to go into in detail, tax liability insurance, but other related insurances like contingent liability, litigation buyout, etc. Now, once businesses are acquired and are in the operational phase within a private equity fund, Marsh assists with managing those insurances on a portfolio basis. And mainly that's in aggregating really the leverage across all of the portfolio companies to achieve cost and coverage benefits. And then towards the end of the investment life cycle, of course, there's the exit process, and pretty much all of the solutions related to transactional risk are equally applicable on the sell side, things like warranties, indemnities, and tax insurance. Okay, so the current state of the market. So it's been a very, very interesting year, to say the least. And just to sort of establish, I suppose, our bona fides. So the PIMA team here in Australia alone would work on something like upwards of 150 to 200 transactions every year. So I really do think we have sort of an eagle's eye view of the market, and we're able to generate insights from that. So I think it's safe to say that in Q2, deal activity was nearly non-existent. A couple of things here and there were happening, but deal activity dried up. Perhaps it was a 70 to 90% decline. Now Q3, there were definite signs of optimism, but despite this, it was still the lowest recorded quarter since 2014. Still, signs were positive. So we were getting busier. We were hearing much more from private equity clients, other advisors, corporates who were considering activity. Now, there's been some recent press about Goldman and McKinsey's current take on the market, and they're pretty bullish on things. So number one, the third quarter represented a strong recovery, but more than that, there's the feeling that the perceptions of boards and private equities are that we really have turned a quarter, and parties are ready to start transacting in Q4. And I can say that from our perspective, we have definitely witnessed that. The team is absolutely as busy as can be at the moment, and we think that there's going to be a real sprint to the finish line for the remainder of the year. So having said that, of course, there are going to be significant challenges to executing deals and managing deal risk in this current environment. So this list certainly isn't exhaustive, but some of the challenges we are witnessing is that buyers are certainly exercising what we believe to be a reasonable level of caution in investigating transaction targets. And a big part of that as well is helping to manage sellers' valuation expectations. So there seems to be still a little bit of a gap on some deals between sort of buyers, I suppose, purchase price expectations and sellers, but we're certainly seeing those gaps narrowing. Related to businesses that are in financial distress, there are certainly M&A issues, and we'll go into some of those in detail in subsequent slides. And then a couple other really interesting new challenges. So first, the FIRB rules were updated earlier this year to say that FIRB approvals were required for lower thresholds. So basically more deals are now needing approval for the Foreign Investment Review Board. Given that so many deals were deferred for so much of the year, we're seeing deals now being done on what we would call ultra compressed timescales. So fortunately, though, we think that the W&I market, W&I underwriters are staffed up, excited to help you all facilitate your deals. And there are now a number of specific solutions that can help you get your deals done in this current environment. Okay, so now delving into warranty and indemnity insurance. So this slide really sets the table. So on the left, we have really the world of W&I. It's intended to cover off unknown risks. So that is, parties go and transact. The buyer typically conducts due diligence, requests the sellers to give a set of warranties in the share purchase agreement, and signs the deal on the assumption that all of those warranties are indeed true and there are therefore no breaches. W&I is intended to cover loss related to unknown or unexpected breaches of warranties. Now, on the right side there is your universe of known risks. And these would be the types of things that tax liability insurance or contingent liability would be intended to cover off. So that is a buyer's considering a transaction target, engages in diligence. The diligence picks up on a known piece of litigation or a known ripe tax issue with the help of an opinion, a legal opinion, tax opinion, etc. Those risks can be ring fenced and dealt with away from the transaction. That's what Kane will go into as we go later in the presentation. Okay, so this slide really is intended to be all of the W&I basics in a nutshell. So the policies themselves have a very, very wide range in terms of limits of liability that they can cover. On the small side down to sort of $5 million, indeed even less sometimes. And on the large side, on a per deal basis, there's more than 1 billion Australian dollars available in terms of limit of liability. Now, the cost for doing that, the premium, really varies by deal. 0.79% rate online is the lowest on a per deal basis that we've seen. Of course, that would be a relatively low risk quality deal. And that might range up to 1.40% on a per deal basis for a riskier sector or a policy with a number of coverage enhancements. Now, the averages, though, are slightly below 1%. So I think we're at about 0.96% this year, year to date, which means that if you needed to procure, say, $50 million of insurance coverage, it would cost you just under $500,000. Now, a few of the metrics that govern these policies. Look, of course, there's a policy period during which claims need to be notified. For breaches of general warranties, tends to be up to 3 years. And for tax matters and also title warranty breaches, that would be up to 7 years. There are certain thresholds for claims payment, a de minimis, which is like your per claim threshold in your purchase agreement, and a retention, which is like your aggregate claims threshold. We've put there the sort of standard options, but there are other more insured friendly options available on nearly all deals in this market. Finally, what does it cover? Well, unknown breaches of warranty, loss under a general indemnity, and loss under a tax indemnity. Okay, so in the current environment, suppose the question is, what have the impacts been of COVID-19? Well, first off, insurer appetite to underwrite W&I remains extremely strong. There's significant capacity available and premium rates have remained stable. So there hasn't been any sort of negative effects on execution ability or insurers' desire to transact. What was interesting was back in April when lockdowns were in force and COVID was relatively new, was that there was an exclusion insisted upon by insurers related to COVID, so loss that arose from COVID. Marsh banded together around the world. We pushed pretty hard back on insurers at the institutional level, so sort of executive level to executive level. And that exclusion has now become a negotiable exclusion. And in most cases, we're able to get a deal done without the COVID exclusion being included in the policy. Now, there are some areas, though, where coverage has gotten, I suppose, a little bit tougher. And one of those is in this concept of new breach coverage. So new breach coverage is a subset of warranty breach where the warranty breach both occurs and is discovered between signing and completion of the deal. Now, in this environment, especially where there might be protracted periods between signing and completion, what insurers are very, very nervous about is that the target business's financial situation or supplier contracts or customer contracts, what have you, might be negatively affected as a result of an outbreak of the pandemic. So typically, there's now a carve out to new breach coverage and related to COVID-related loss for those deals that have new breach coverage, and not all of them do. Moving on, one of the interesting impacts of COVID is that we expected to see a big increase in distressed transactions. I think, in fact, given how Australia and New Zealand have dealt with the pandemic, specifically JobKeeper in Australia, there have been fewer distressed transactions than we expected. There are still those solutions available, and and challenges as well, which we'll go into as we go later in the presentation. Finally, we touched on FERB, so I won't reiterate that, but there is certainly a recent marked increase in deal flow. And it feels to us like there's a little bit of a dam, and that dam has now been released, and there's a flood of deals coming through the practice. Okay, so one of the specific innovative warranty indemnity solutions available in the current market is the use of synthetic W&I. So here, the idea is that if a business has gone into administration, gone into receivership, in other jurisdictions declared bankruptcy, and there's a sale being led by an administrator, typically neither the administrators nor the sellers would give any but the barest of warranties. So synthetic W&I, though, is a way for a buyer to protect their purchase price in one of these deals by embedding a suite of standard warranties into the W&I policy itself. So that is, they get a bit of protection if one of these warranties isn't true. But the big benefit really is that the warranties don't actually have to be given by the administrators, the sellers, or the target. So the parties on the sell side are in no worse position, but the buyers get to protect their purchase price. This type of solution can be suitable for either an administrator or receiver-led process. Just a couple of tips, I suppose, is that the involvement of target management engaging in the disclosure process is very, very helpful, as is, of course, the buyers conducting a commercially reasonable due diligence exercise. In terms of coverage and rates, the warranties that would be covered would be typically be considered sort of middle of the road, commercially reasonable warranties. And then premium rates might be a bit higher than your more standard W&I, but not significantly so. Okay, another interesting current use of the product, and this isn't brand new as a result of COVID, I'm doing it for a few years now, but is the use of W&I on public to private transactions. So this is it could be a corporate buying a publicly listed business, a private equity firm buying a publicly listed business and then privatizing it. The takeaways here really are that there's keen insurer appetite to do these deals, and they can really be done on the same basis as a private W&I. The process, the informational requirements, the timing really are much the same. Now, similar to the synthetic W&I, it means really that buyers can gain additional deal protection. On your standard public deal without W&I, there would rarely be operational warranties in the document. Public W&I insurance is a way of getting those operational warranties. One distinction that's very interesting is in these deals, the warranties are typically given by the target, not the sellers. That was a real coup a couple of years ago. We got insurers to agree to that concept. Now, the quid pro quo, I suppose, for insurers who would then effectively be losing their subrogation right because the target will cease to exist post-transaction, is that they do then look for an exclusion related to potential target fraud. Okay, so always a question really about premium and how do insurers reach the premium figures they do. Well, there's no hard and fast formula. Most of the W&I underwriters are former lawyers and definitely more oriented towards words always than numbers. So, but the way the pricing is derived really is a combination of objective and subjective factors. So number one, on the objective side, they look at the limit of liability, and then the limit is the function of the total enterprise value or purchase price. Larger limits tend to be have lower premium rates, and then the larger percentage of the deal value you insure tends to positively affect the premium rate as well. The thinking there is that the insurers think that if the entire deal is insured, the likelihood that the entire limit will be eroded by a claim is lower. Now, there are different retention options. We talked about fixed retention earlier, of course, of 1% of purchase price. Other options available as well, like 1% tipping to 0.5% of purchase price, even tipping to nil in some cases. Those types of enhancements would would incur some additional premium. And then sort of subjectively, the insurers just look at the deal generally, they get a feel for it, they look at the warranties, they have the question to themselves, are these particularly buyer friendly? Are they particularly comprehensive? Is a breach going to be more likely or less likely? And if they're particularly broad, that might affect pricing. And then the insurers also look at the sort of negotiating leverages between the two parties. And they look for sort of two sophisticated entities being well advised, and then that gives them comfort that the warranties will reach a middle of the road reasonable position. Okay, so moving on, this is quite a wordy slide that I'm not intending to talk through every word of. Basically when we think about these policies, the policy negotiation comes down to really three main areas. So number one, aligning the policy as closely as possible to the operative share purchase agreement. Number two, procuring coverage for all of the key warranties. And then number three, minimizing to the extent possible any exclusions that would be sitting in the policy. On the SPA and policy alignment, there are a number of clauses that tend to dovetail between the policy and the SPA. Things like the disclosure scheme, definition of consequential loss, etc. But then there are also a number of SPA provisions that can be varied in the policy. So if the limit of liability in the purchase agreement says that the sellers will only be liable for up to 10% of the purchase price in the event of warranty breach, well, buyers might want more than that, and we can get them more. And then the SPA provisions can be disregarded for that purpose. Now, on the warranty side, our goal is absolutely to get coverage for every single warranty to ensure that the policy and the SPA are back to back and there are no coverage gaps. Now, listed here are some very common key warranties that are carefully negotiated on each and every deal. But in addition to this, what we do carefully consider is what's the value of the target business for a particular deal and what warranties would be the most important for that deal. So if it was a technology business being acquired, of course, people would be concerned with intellectual property and IT style warranties. But numerous other examples abound, of course. Now, on the exclusion side, there are a number of standard exclusions that typically track some of the exclusions that you'd see in the purchase agreement anyway. And then some of those are pretty standard insurance exclusions. Now, there are a number of negotiable exclusions, but really where the rubber hits the road is our negotiation with the insurers on any potential deal-specific exclusions. And these generally are matters that arise out of the diligence that insurers will want to understand. Okay, so this slide is what we call tips for success. So just a few points that we see occasionally making coverage negotiations difficult on deals. If we can solve for them early in the process, it helps our clients get better coverage, and it's just a way to set ourselves up for success. So number one, diligence. Important for a buyer to engage in a commercially reasonable diligence process where the material risks of the business being purchased are properly assessed and diligenced in written reports. I've already touched upon this point in the pricing, but if there's a serious lack of parity in negotiating leverage, or if the seller is not engaged in the negotiation process, that can make it difficult. Insurers want to understand that the sellers are being well advised and that they're negotiating the warranties as if there's not warranty indemnity insurance. They don't want the sellers to kind of roll over so that the warranties become so buyer friendly. Third is timing. We can certainly get these processes done in 3 to 4 weeks. That's quite standard. When we're asked to do the underwriting in less time than that, it's not that it's not possible, but it can seriously compress the amount of time we have available to negotiate for coverage. So having at least 3 weeks is fantastic. And then finally, small transactions, which we're calling deals under about $10 million. They're insurable, but the premium rates tend to be a little bit higher due to certain insurers charging minimum premiums. Okay, so this is a brief slide on process and timing. So the key here really is that it's preferable, we believe, for us to be engaged early because we can provide feedback on insurability, on how to set up the mechanics in the SPA to help achieve a positive coverage result later, and then also to strategize about how to present the transaction to insurers. In terms of the process from there, step one would be we market the deal to insurers. We're a market maker. We present the deal in the best manner possible so that we get the best coverage and pricing quotations. And then we provide recommendations as to which insurer you should proceed with. Once an insurer is selected, the underwriting process begins. And that's when things like diligence and data room access is given, and there's typically that underwriting conference call that occurs. Now, from a process perspective, we can do these in many, many different ways. The process itself is highly flexible, it's highly malleable. And just two examples here are that we can work on behalf of an exclusive buyer, exclusive bidder to get a deal done in that sort of 3-week process before signing. Alternatively, we often do these as what we call sell by flips. So a seller is considering the sale of a business. We might get involved months before the proposed signing, and we would put W&I together as a stapled solution that will be presented to bidders in an auction process. Okay, so this is our 4-year data set regarding some of the key metrics: rate on line, limit insured as percentage of purchase price, and then kind of whether we're doing the bulk of our work for private equity firms or for corporate buyers. So first off, on the rate on line, I'm pleased to say that there's been a multiple year downward trend on premium rates. Now, you can see we're a bit up and down there, 2017 to 2018, but actually the 6-year trend has certainly been downwards. What's very, very interesting to me is that in that period, for the most part, the limit as a percentage of the purchase price across all deals has remained pretty stable. So about a third of the purchase price is about normal to get insured. Having said that, though, that varies really greatly. I mean, if we're doing a $1 billion deal, the parties might buy just 10% or 15% of the purchase price in terms of the limit. On the other end of the spectrum, if you're doing a smaller deal, often that might be 100%. But for your sort of red meat, $100 million to $500 million kind of mid-market deals that we're doing, probably the most often, about 30% normal. Now, one very, very interesting multi-year trend has been the breakdown of our work for private equities versus corporates. And there's been a major upward trend in our work with corporate buyers over several years, which we view as being very pleasing. The policy, really, the genesis was with the private equity world, and we absolutely love our private equity clients. We believe that corporate take-up rates are one of the next frontiers. Okay, so we talked earlier about the retention and what other options there are available on retentions. These represent the 4 most typical retention options, and then sort of the percent that we see at most deals. So 1% is the most common, but tipping retention structures have become more common. And you can see that these aggressive structures, 0.5% fixed, a tipping to nil structure, these are now being taken up pretty regularly. Okay, so just a couple of brief case studies here. So this was a very, very interesting deal. So this was a sell by flip. We were contacted by one of our financial investor clients who were looking to sell a manufacturing business. So there are a couple of key objectives. So number one, they wanted a clean exit for themselves. Then they also wanted to create a time-efficient W&I process that would provide good quality coverage to the selected bidder. So that basically, they want to leave the bidder feeling, number one, good about getting the deal done with W&I being in place, but they also wanted to minimize the chance that the bidder might seek direct recourse with them. So we were involved very, very early in the deal. In fact, we helped do some of the SPA drafting, which was exciting for us. And then, early in the piece, we had an insurer selected And that insurer was able to review the vendor side diligence, prepare a diligence gaps memo, which provided a diligence, what we call roadmap bidders, to basically set themselves up for us to help them set themselves up for success. We provided input, of course, on the W&I mechanics, and then we kept the bidders quite informed of the process by uploading materials to the data room on a regular basis so that they felt like they knew exactly what was going on. Once a bidder was selected, we were able to get the W&I done in a compressed timetable between bidder selection and signing. I think it was just 2 or 3 business days, so that was a real win. Second case study was another really pretty exciting deal. So a private equity fund investing into a business where the sellers were rolling over into the new business. So the sellers are going to become part owners, co-owners with the private equity firm post-transaction. The real point of difference on this one was that despite the fact that the private equity firm is only going to have a 60% shareholding in the new business, we were able to negotiate with the insurer for loss, that is, a payment in the event of a warranty breach to be paid on a 100% basis. So that was a real win for the client, and look, it worked well for all parties involved. Okay, so I think this is my last slide before I hand over to Kane, but this is all about claims. So none of this work that we do in terms of pricing the deal, getting coverage, having negotiations, none of it really matters unless claims are being dealt with efficiently and, of course, being paid. So I suppose the trend with this really is that all of the insurers have become more sophisticated at managing claims, and claims have become much more common and much more common feature of W&I policies. You can see there the graph on the top right shows just how sharply the number of notifications have increased since 2016. So we're finding that the increase in insurer sophistication on claims has had a couple of positive effects. So number one, claims are being settled more quickly, and they're generally being paid in amounts that are acceptable to our clients. Claims are coming from deals really of all sizes, but what we are seeing is that claims are being notified earlier and earlier following deal completion. Now, in the bottom right there is a breakdown of the claims we see per the type of warranty breach. And you can see some of the areas where you would probably expect to see claims. Matters like tax, financial statements, compliance with laws, employment. So these are all matters that would be carefully negotiated by the lawyers, even without W&I. But our data does back up that these are indeed the most important, really, warranties that get negotiated with or without warranty indemnity insurance. Okay, well, that's it for my piece. I do see that a question has come through in regards to W&I. I'll hand over to Kane now, and then we will field all of the questions during the Q&A session. Thank you very much.
Thank you, Chris. I know everyone's been waiting with bated breath, so let's jump straight into tax insurance. And what I want to give you is a good sense of how tax insurance works, how it can be used by you or your clients as a key risk allocation tool in the M&A setting, and then what the market looks like generally and the growth of the use of this product in this region. At its core, tax insurance protects against the risk of a tax authority successfully challenging a tax position that's been adopted or will be adopted and determining that a tax liability is payable. What tax insurance does is essentially transfer that liability to the insurance market, so the financial exposure is not being borne. At a macro level, tax insurance can be used very flexibly and in a lot of cases can really become a critical part of your M&A strategy itself. It provides financial certainty at the time of a transaction and also that protection going forward for both parties. What this also does is create a lot of opportunity a transaction to proceed, which might not otherwise, and unlocks cash, which can be used in other areas of the business. At a glance, this is what a tax policy covers: the core tax liability itself, the penalties and interests associated with that liability, the gross up to the extent insurance proceeds are expected to be taxed in the hands of the insured, and defense costs in the event of a claim. So all of those things are bundled into the limits under the tax policy and can be covered. Policy period will be at least the statute of limitations in the jurisdiction involved, and we can seek up to 7 years under the policy. The premium, expressed as a percentage of the sum insured, or what we call the limit of liability, it's very much a wide range here, somewhere between 2 and 7%. And the reason that's so wide is because it's a reflex of tax being complex. And every risk that comes across our desk will be assessed on a case-by-case basis. And we'll talk through some of those factors that affect pricing and what underwriters are thinking about when they do look at a risk. The thresholds, there's no de minimis. Once a policy is put in place and there's a limit under that policy, depending on the quantum of the risk itself, that's fully covered. What may be payable in the event of a claim is the retention or the deductible, and that's also negotiable on a case-by-case basis. In terms of capacity, it's really pleasing for me to be able to say that we can get in excess of $500 million or so per risk. We have single insurers who can come in and provide more than $200 million. And then if the risk itself exceeds that amount, we can always build a syndicated tower and essentially bring in excess layers of insurance to cover the full quantum of the risk. But that's really a product of the strong appetite amongst insurers, both locally and globally, to support businesses and transactions with tax insurance. Some of the key considerations when thinking about whether tax insurance is relevant for a transaction and for a particular risk that you've uncovered. One, it needs to be a known and quantifiable risk. This is really designed for those risks, not the unknown, as W&I is used to protect. So once there's a known risk, we then look at whether it's supportable and what level of certainty parties have with respect to that risk, and whether there's disagreement between parties in a transaction, a seller and a buyer, as to the specific treatment that should have been adopted. What's really important to note is that tax insurance is a commercial option like any other insurance. And what it's really designed to do is to help provide commercial benefits in a deal setting. And this is where a material risk is identified that creates financial or commercial hurdles, then to think about how we can get involved to help solve for that and essentially facilitate that transaction. The risk itself needs to be supportable, as I mentioned, and we'll talk more about what that gateway threshold looks like. But tax insurance is essentially not designed to support risk that can't be supported by advisors. Tax insurance is not a new product. In fact, it's widely known and used in other regions around the world, particularly the UK, Europe, and the US, where literally hundreds of policies are bound each year. In Australia, it's still very much in its infancy, although we're seeing that change in the last 12 months or so, with a real uptick in the level of interest and inquiries coming through, and policies bound in this region. That's really positive and creates a healthy environment for us here, because it marries value for the client, and also with that appetite from the insurance market, we're able to access really competitive prices to pass on to you. The reasons why it is being seen as such a valuable tool in Australia, New Zealand, and this region more generally, is because we've got all the same ingredients that has made it so successful in other parts of the world. A strong rule of law, legal precedent, established tax and political system, all being married up to married up with high levels of review and audit by the tax authority, and the uncertainty that has created for taxpayers in this environment. I'll talk through how tax insurance can be applied and put in place for both a buyer and a seller. Looking firstly through the buyer side lens. One, where a known risk is identified as part of a diligence exercise. That's the most common scenario. And that can create the traditionally the options then that parties would resort to are fairly unpalatable commercially and typically include funds being put into escrow while tax clearance is sought, or an adjustment being made to purchase price if that risk is treated as a debt-like item on the balance sheet. Especially in this environment where every dollar matters and negotiation around valuation of a business, as Chris mentioned, is narrowing, but there is still that gap in certain cases. And this is really where tax insurance can be used as a viable alternative to those other options, where essentially that risk can be taken off the negotiating table altogether. That clearly aids negotiation, reduces friction between parties, and helps get the deal over the line. It's important to note that W&I covers a lot of risks when a business is being acquired, but what it does not cover are known risks. And a W&I policy will typically have specific exclusions for areas of tax in some cases, such as transfer pricing or losses, and those clearly will not be covered. What can be a blind spot in certain cases are the risks which are not specifically excluded under W&I policy, but are nonetheless not covered because they have been fairly disclosed in the diligence and deal process through matters that have been identified and addressed in the diligence reports, either buy side or sell side, the Q&A disclosures, and the information that's been populated in the data room. All those things are considered to be disclosed. So if they're not being covered by W&I, it's then important to consider if it's material and creates risk and uncertainty of parties, how they can be covered by a specific tax insurance policy, which I should say can operate as a supplement to W&I in a transaction, or completely on a standalone basis if W&I is not a feature of the transaction. In this current business environment, we're seeing a lot of buyers come to us with concerns over the financial substance of a seller and the difficulty that presents in a claim scenario 2 or 3 or 4 years down the road. And that's really where putting in place an insurance policy means that a buyer can have that certainty knowing that if there is a loss and that crystallizes, they can then have direct recourse to the insurance market without having to pursue a seller, which often also preserves relationships when target management or seller management continues to be a part of the business going forward. This list here is certainly not exhaustive, and what I really want to say is that essentially any tax risk, any area of tax can be covered under an insurance policy. Of course, there will be gateway thresholds that need to be met, and with certain areas of tax, there'll be a high risk profile attached to them, and that will affect the underwriting and the price. But as a default position, what I want you to walk away with is knowing that if a material tax risk arises, it can be insured. Even areas that are considered traditionally to have been uninsurable, such as transfer pricing, anti-avoidance rules. Areas of current scrutiny, such as employment taxes and misclassification between employees and contractors, the availability of losses, the whole suite of international tax issues, withholding taxes, treaty relief, and domestic exemptions. All of these risks can be covered. On the sell side, sellers really want to achieve one main objective, and that is, well, 2 objectives really. One, to achieve the best price possible, and secondly, then to be able to walk away from the transaction without a contingent liability. So achieving a clean exit. That's exactly what insurance provides for them. What can be covered are the risks. This is the most typical scenario associated with the target pre-completion. But it can also cover, and we've worked on a number of transactions with corporates and funds where they're seeking protection and certainty with respect to pre and post deal structuring, and also the treatment of proceeds in the hands of a seller. A recent example of that is an inbound fund looking to protect the exemption that they avail themselves of in selling their Australian asset. And that allowed them to repatriate those funds without setting aside cash in the event of a contingent liability if the tax authority were to disagree with that treatment. Coverage is typically by way of a buy-side policy. That is far and away the most common structure that we see, because it means that buyers, in the event of a claim, as I mentioned, can go directly to an insurer seeking to be made whole from them, and they don't need to pursue the seller. From the sell side perspective, that means they're completely extracted from that claims process, giving them a really clean exit. Again, just a list of a few examples of how tax insurance can aid from the perspective of a seller, both from an inbound perspective with that example I just spoke of, and also for corporates that are headquartered in Australia who have outbound investments and are looking to divest those assets. We had a recent example of a company looking to sell indirectly assets that they had in Indonesia, and the concern was that the Indonesian tax authority in the future may seek to invoke their long-arm CGT rules. And so we were able to protect that position for the client in case that were the case in the future. They then were able to use that money and reinvest it into other areas of the business. We've been talking about how tax insurance can be used in M&A, and I'd say that represents about 70% of the use case, but very quickly, tax insurance can equally be used outside of the M&A context altogether for portfolios and business as usual operational tax risks, either with respect to historical positions that have been taken and have been filtered through the returns year on year, or forward-looking positions with respect to reorganizations and or debt restructures. Where we see a real benefit is in time-sensitive matters for a restructure, for example, where seeking insurance can be used as an alternative to seeking a tax ruling, which obviously comes with uncertainty, but can also take a lengthy period of time to clear. What feedback we're getting from CFOs and heads of tax for corporates especially is that what appeals to them is the upfront certainty of cost, being able to pay that small percentage now as a one-off premium, and having protection in the go forward for that other 95% of the risk that has not been paid through insurance, and freeing up their balance sheet and unlocking cash so that they can use that without risk of that being required to satisfy a latent or contingent tax liability in the future. Some of the price drivers behind a policy, the nature of the risk itself, and the complexity of the area of law and differing views of interpretation, the arrangement itself, especially when it comes to fact-dependent areas like transfer pricing or anti-avoidance rules, the jurisdictions involved. So Australia, New Zealand, generally considered to be lower risk jurisdictions, and that's reflected in the coverage and pricing that we can obtain for you. Insurer risk appetite, they have varying mandates and policy parameters, and that will also dictate price. And the limit of liability being sought. If it's less than, say, $3 million or so, we may see a slight upward skew of the rates. All of these factors are considered in a qualitative manner. There's no algorithm that spits out a rate, and so these really are the key reasons that there is such a wide range. I'm seeing about 3-4% being typical in the risks that have come across my desk in the last few months. But again, every case, all of these factors will need to be considered when looking at the price. Just conscious of time, so I'll make my way through the next few slides pretty quickly. This is a really important one. What is the price of admission to put a tax insurance policy in place? One, it's it's ideally a should level of assurance on the risk itself, reflecting that chance of success in the event the position were to be scrutinized and ultimately challenged by a tax authority. What that looks like is a 70 to 80% level of comfort. And that often begs the question, well, if we can get a should level opinion, why is insurance required? And the answer to that is simple. It's because even with a should level of assurance, in a lot of cases, if you were to ask your advisor, some they'd say we're 95% sure on the chance of success if this risk were looked at. In other cases, they might say there's really a 65, 70, 75% level of comfort that we have on this position, which means there's a 1 in 3 chance that if the position were looked at, the tax authority would disagree. And that represents a really good candidate for insurance. Secondly, we need that position to be supported by an opinion from a tax advisor, Big Four, law firm, any reputable advisor that can provide that technical analysis and conclusion. And then, of course, we'll need access to the documentation supporting the key facts and assumptions that underpin that analysis. So they're really the key requirements for a tax insurance process. Process and timeline takes about 3 to 4 weeks. We can do it on an expedited basis, and we have done that depending on the deal dynamics. I won't really talk through this, but safe to say, have an early conversation with us. We'll then really guide you through the entire process. We're a market maker, so we bring the risk, yourselves, and your commercial objectives, and we marry that up with what we can provide from the insurance market. We negotiate the policy to ensure we get best coverage terms for you, and of course, best pricing. And we'll work hand in hand with yourself and your advisors to do that. Here really are a few case studies that bring alive the commercial value and how flexible the use of tax insurance can be in a transaction. One, there's a buy-side policy, which, as I said, is most common, providing a competitive edge for bidders and giving them that certainty on that risk going forward. That's the most common example that we see in a deal context. But we're increasingly seeing sell-by-flip structures where a seller will proactively identify risk associated with the target that they're selling. They'll then initiate that entire process with a view of flipping that to the buyer to essentially aid the deal timeframe and give the buyer a pre-packaged solution that they can then execute in a very, very time-efficient manner with us. Sell-side initiation, and we're working through one of these now where it's to cover a liability, which in fact will be borne by the buyer. The seller wants to incentivize and increase the attractiveness of the deal itself. And so they're initiating the entire process and underwriting that, and then proposing to share the cost of the insurance with the buyer. And that's even though it's a buy-side liability, stamp duty in this case. Sell-side policies can be taken up as well, and we are also working one of those where a seller has given a specific indemnity to a buyer to cover a tax risk. They're now looking to wind down operations, and they don't want that indemnity that they've given to the buyer to impede their future divestment intentions. So they're looking to take out a sell-side policy to protect them and provide back-to-back coverage with the indemnity that they've given. And of course, then we have the BAU risks, which I spoke about briefly, for corporates and the operational tax risks completely outside the deal setting. So as you can see, it can be used very innovatively, and in all these contexts provides a different commercial benefit to buyers, sellers, and corporates. And that's it for me. We'll now open the floor to the audience. I know we've received a few questions. So Chris, I might start with you. I did see a couple of W&I questions come through earlier.
Yeah, thanks, Kane, and thank you very much. So we've had a few questions. Most of them are over for Kane for the exciting portion of the presentation, really. But the first one here is on W&I, which I'll handle. So the question is, for W&I policies, what is the incident reporting claim investigation process? And then are investigation costs like forensic accounting generally insured? And if so, can policyholders select who they use? The process for reporting a claim is pretty straightforward. Initially, a claim notification needs to be prepared that just outlines the facts, matters, and circumstances leading to the claim. So what warranties have been breached, what's an approximate value of the loss, when did you learn of the breach, etc. And then typically an insurer would respond with a request for information when yourselves and your advisors typically would get into a more of an investigation of the nature of the claim. Now, your own investigation cost in terms of assessing the value of the loss would not be covered by the policy, but it is right that oftentimes a forensic accountant would get involved for a complex matter. So generally speaking, the claims process, not in all cases, but oftentimes is split into two parts to a degree. And those two parts are that number one, there's a negotiation around the insurer confirming that the claim is covered, that indemnity is granted. And then once that's done, that's often when valuation experts get involved. But the cost of those valuation experts would not be paid for, insured. So I'm sure you can see the questions here, but the next one is over for you, and that is, does tax insurance generally sit on top of W&I insurance, or do parties tend to get one or the other?
Thanks, yeah, and it's a good question. Tax insurance can be used on a standalone basis for any material tax risks that are identified, or it can be used as a supplement to W&I, and this is very common for us actually seeing W&I being a feature of a transaction, and we see a majority of transactions featuring W&I these days. And if there is a material risk in that transaction, then taking up a tax insurance policy to address that specifically. So they can sit side by side, or either product can be used independently. And we see both of those scenarios all of the time.
Yeah, thanks, Kate. Then we have two more questions that pertain to the same subject matter, and that is, who are the carriers of tax liability insurance? What insurers are you working with?
A number of insurers. We have insurers here locally, such as Liberty and AIG. Both have local presence, are dedicating a lot of resources and are very much committed to supporting businesses with tax insurance. And we're also working with a number, I'd say over a dozen foreign insurers that have very much a keen appetite to write risks in this region, particularly including Ambridge, Brockwell, Themis. There really are a number of them, a combination of very long-standing insurers and other underwriting agents as well. So across that entire insurance market, we can generally get most risks covered.
Excellent, thanks. And then one more question has come across, and I'm conscious that we're coming up to our time, but the question is an insured of a tax liability policy the target company?
So one, I'll say again that a policy can be put in place very flexibly in terms of who the named insured is. And what we'll typically do in a transaction sense or outside of a deal context is we'll look at who the tax authority would pursue in the event they challenge the position and the liability is crystallized. So that could either be the buyer entity, for example, if that's a head company of a consolidated group that's going to consume a target group, or it can be the target entity itself. Really, we're very flexible, and we can have a number of insureds under the same policy as well, to ensure that if there is a liability, there is an insured that will be covered that can then pass that on to the tax authority.
Okay, excellent. Thank you. I might just have one more open call for questions, if any. Okay, doesn't look like there have been any more questions. So look, I'd like to close out really by thanking Kane for the enlightening presentation on tax, and more importantly for thanking you all for taking time out of your day to listen to our insights on warranties and indemnities and tax insurance. Thank you all.
Thank you.